is going to change your perspective 100% of the profit. And that's what we're here for, because how powerful it is. And once you understand this, boom, here's where the magic happens, right? So you're making money while you sleep. $6,000 per year. Sounds like a lot. 343,000 really breaking the bank. You have 68,000 shares. Not mind-blowing, but my goal is to go even higher. What's going on, fellas? Mr. Mokwin back again for another win. And today I'm going to be explaining why dividends are a superior portfolio allocation. Okay, basic terms to go over. Portfolio is basically a group of stocks or a group of whatever investments you have will be your portfolio. Dividend. A dividend is when you buy part or aka a share of a company and they pay you a certain amount of their profits based on how much you own. So if you're 100% owner of a company, you get 100% of the profit. And then you bust that down to maybe 1 million shares. Let's say you get 1 million of the total profit via dividends. Dividends are paid out either monthly, which I prefer, quarterly every 3 months, semi-annually every 6 months, or annually once per year. And the most important factor in why dividends is so powerful is what's called compound interest.
Something just came across my desk, John. It is perhaps the best thing I've seen in the last 6 months.
Right? Compound interest is you getting paid interest and reinvesting it, and then receiving interest on your interest. So Albert Einstein called compound interest the 9th wonder of the world because how powerful it is. And once you understand this, it's going to change your perspective on time and investing completely, right? And that's what we're here for. So in order to tap into the power of compound interest, what you have to do is DRIP. What is DRIP? Dividend Reinvestment Plan. Whatever dividend you're receiving, and instead of spending it, you are using that to automatically buy more shares into the same company that's paying you the dividends, which increases your dividends. Let me do a real basic example, right? Say you have XYZ company and their share price per piece of the company is $5. Boom. And their dividend yield, which basically means the percentage of the share price you'd receive in dividends. The company is $5 a share and the dividend yield is 10%. That means for every one share you bought that cost you $5, you would receive 50 cents in dividends. So let's say you bought 10 shares. Real easy numbers, 10 shares, $50, right? For that $50 that you spent, you would receive $5 in dividends for that year. Like I said, they could either be paid out monthly, quarterly, semi-annually, or annually, right? So if it was paid out annually, you just get the $5. Semi-annually, you get $250 every 6 months, so on and so forth. That $5 that you received that year, you would be enrolled in DRIP, so you would automatically reinvest it back into buying more shares of the company. So you start off year one, just throw $50 in, you have 10 shares, boom. Once you get paid that money, it automatically buys, if the share price stays the same, another share, right? So now you have 11, because remember the share price is $5. So now you have 11 shares of XYZ company. So that second year, the payment you will receive would be $5.50, because you're also making money on the share that you bought via your dividends paid to you. Then the dividend you get paid jumps to $6, right? So after that first year, you're buying yourself one share per year without actually coming out of pocket. Here's where the magic happens, right? This is the powerful part. Then after about 20 years, right, Now, mind you, this is only $50 investment. You put $50 in, you let the drip do its thing, and you never look at it again. Let's say you forgot about it, right, for 20 years. Then you would be making about $30 a year over 66 shares. And let's say the prices all stay the same. The value of your portfolio would be about $336, right? Not mind-blowing at all. But remember, you put in $50 and you completely forgot about it. So that's nice by itself, but this is how you supercharge your portfolio. So now you have the money you put in and the dividends working for you, right? So you're making money while you sleep. Now, what happens if you regularly add to your portfolio? So scenario one, just add in the $5 a month or the $60 per year. At year 20, you'd end up with nothing crazy, but the $50 plus the $5 a month isn't anything crazy. It's a more slow, methodic process of getting wealthy. Unless you do something else or you save up really well and you have a large chunk of change to throw at it, or you're putting a lot in per month or per week, or however you want to do it. Scenario two, now you're adding $1,200 per year or $100 a month to the portfolio, still reinvesting everything. Boom. You have at the end of 20 years. And lastly, portfolio three, $6,000 per year, right? It sounds like a lot. If you break it down, it's about $500 a month. At the end of 20 years, reinvesting all your dividends, adding $6,000 per year. Your portfolio value, keeping all the numbers the same, will be approximately $343,986. You have 68,979 shares, and your annual dividend payout would be $34,398. So basically $35,000 on that 20th year. You'll be making a side income of basically somebody's minimum wage job. Try to show you basically an initial investment, nothing else, a very cheap investment, moderate, and I think a lot of people would consider $6,000 a year invested a decent chunk of change. But my goal is to go even higher than that.
I'm gonna do what I want. I'm gonna spend all my money, every damn dime, and buy what I want. This right here is what I want. Yeah, that right there. Forget them damn bills. This is my dream. Mine.
Another caveat is 10% dividend yield is pretty high. I look for roughly half that. So that's another factor to add into any scenarios you're trying to plan out. Another great part of dividend investing is the fact that I enjoy bear markets. Bear market is basically when the market's going down. A bull market is when the market's going up, right? That's why they have that big bull on Wall Street. Because the share price is going down in a bear market, that 50-cent dividend per share you're getting can buy you more shares, which will grow your income in your portfolio faster. So that same example, if you have the $5 per share and 50 cents payout per share, and the stock price drops to $2.50, you're literally doubling the amount that each dividend payout can buy you. You're getting 50 cents per share, aka $5 for the year. And then the dividend one, if you buy 10 shares and the stock price drops to $2.50, now you bought 2 more shares. So instead of that first year, you're going from 10 to 11 shares. If the stock price cuts in half, then you'll be going straight from 10 to 12 shares. If you were to go to a store, right, and look at a pair of Jordans for like $200, but think it's too pricey, and then go back another week and the same pair be $100. That's a bargain, right? You might even buy 2 pairs. So why is it not a bargain when a stock price drops? Because people panic when they see their portfolio overall number lower, but it's really doing me a favor when the stock price drops. As long as it's a viable company, it's not gonna go out of business. I think this is great for people who have kids or people who potentially wanna have kids. I know my daughter has a very nice portfolio. She's making about $6,000 a month at 2 years old, right? And I haven't even been adding to it. It's just from the initial investment. Because obviously 10, 20, 30 year time horizons might look daunting, but if you have a little kid, you can start from pregnancy till 18, and that could potentially pay for their college, or if they don't want to go to college, you can help fund whatever they want to do as an adult. Let's compare it to real estate, right? Would you rather buy a home and hope it goes up in value and then maybe get some equity out of it, or sell it, cash in on the value increase or the equity increase? Or would you get a rental property, and whether the price of the house goes up or down or sideways, you're still receiving a payment every single month, no matter what happens with the property or the property value? I feel like that's how dividends relate to the real estate market. Dividends is like basically a monthly rental I'm getting, whether the stock price goes up or down or indifferent.
Nobody knows if the stock is going to go up, down, sideways, or in fucking circles, least of all stockbrokers.
And that, my friends, is why I think dividend investing is superior to most other investing. Now, again, I'm not a financial advisor. I'm definitely not your financial advisor. And this is just what I'm doing with my portfolio. So you can take it how you want it. Don't forget, like, comment, subscribe, or your Jared's gonna pop up with the demon back.